thanking you for joining us this afternoon. I thought I'd go through four basic things. I'll give you a bit of a market update and go into some details about what's been going on in the market and what's been shaping this recent weakness. We'll talk about some of the opportunities we're seeing in the market and some of the challenges we're seeing in the market. And then I'll just finalize by giving a bit of a portfolio recap of what we've been up to these past few months. We're a strategy where we try not to have too much turnover, but when volatility rises, when the VIX rises, we do sort of pick up our trading activity. So it's been a reasonably active start for the year for us. So my intention is that I'll sort of run through these slides in about half an hour or so. Okay, so we've had 3 stellar years of returns from 2019 to 2021. The long-term return on equities as an asset class, depending on how you measure it, is in and around, call it 8.5 to 10% in US dollar terms, depending on the market and the time frame you're looking at. In 2019, 2020, and 2021, we had 3 years where the worst of those 3 years was 15%, and the best of them was about 24% in US dollar terms for the MSCI World Index. So we started, we started 2022 in a position where stocks are reasonably expensive. A lot of good news had been priced in, and we'd had 3 fantastic years. And so it's you need a steady diet of increasingly good news for equities to work over the short term and that kind of backdrop. And we've had a rough start to the year. This is just a line chart of the various geographic buckets. The thing I'd point out is how so many markets are effectively clustered together. The States, Japan, European equities, emerging market equities are all very similar orders of magnitude, down sort of 12 to 15%. That'll be more like 15 to 17% after today. Canada, as it happens, is one of the best performing markets year to date. Energy is a big part of the Canadian stock market. So it's not a huge shock that market has done well, but geographically, the weakness has been broad-based. From a sector standpoint, it's been highly unusual. The only sector that's doing well this year is energy, and you can see there up almost 30%. And then a whole host of sectors are down pretty substantially. And this is a pretty unusual skew because energy is amongst the most pro-cyclical sectors. It's amongst the most highest risk. Usually it does well when we're coming out of a recession and when growth expectations are accelerating. We're in the opposite environment right now. GDP growth expectations are decelerating, but because there's so much anxiety around long-term energy supplies, and that anxiety was sort of increasing even prior to the outbreak of the war between Russia and the Ukraine. Energy's got a bid, but you see those second and third best performing sectors there, staples and utilities. Those are 2 of the 3 really defensive sectors, healthcare being the other. So it's unusual that you'd see energy and then staples and materials, then followed by materials, which is where the mining stocks are. When the stock market puts in a bottom and recovers, what we're going to want to see is leadership from some of these names here on the left-hand side. So consumer discretionary, tech, industrials, financials. For the market to kind of put in a bottom and start to recover, those 4 sectors, not necessarily all 4 of them, but at least, let's say 2 of the 4 of them need to start working. There's been 3 main reasons why the stock market's been so weak this year, apart from just perhaps a natural reversion to the mean. And these are roughly in ascending order of importance. So the Chinese economy had already been slowing down. There had been pretty, I think, reasonably well understood crackdown on Chinese private sector and technology companies in the last 18 months or so. That has really curled investment appetite and business confidence in the country. The chart on the right sort of draws a parallel between the decline in the Chinese real estate equities relative to what was seen in the States and Spain when their real estate markets corrected. And, real estate's a huge source of savings and investment and economic activity in China. And as that sector starts to reckon with the overbuilding that's happened there and with the stretched balance sheets in the Chinese real estate sector, those stocks are under pressure. And then most obviously, the return of broad-based crackdowns throughout China, but especially in Shanghai and Shenzhen, which are key commercial cities, is absolutely going to limit economic activity, not just in China, but around the world. To give you an example of that, Texas Instruments, the analog semiconductor company, big blue chip stock, and a very good sort of company to follow if you want to sort of want to take a real-time temperature of what's going on in the global economy. When they reported earnings the week before last, the earnings themselves were quite good, but the guidance was quite weak because their outlook in terms of receiving components from some of their Chinese suppliers and then delivering partially assembled components back into the Chinese supply chain, they just had no visibility there whatsoever. We don't have a position in TI, but we've got a position in a similar stock called Analog Semi. And then Emerson, which is another sort of blue chip US industrial company, which we do have a position in, similar sort of thing when they made comments about the ability of, the inability to get trucks in China to take components from one factory to another factory 10 kilometers away, many distribution centers and factories being closed. So just very, very practical headwinds to economic growth. The second source of market weakness is, unsurprisingly, the war in Ukraine, and in particular, what that war means, in part for business and consumer confidence, but more immediately, what it means for inflation in Europe. Rough estimates of the impact on Eurozone GDP from an outright ban of Russian energy imports, so that this would be both natural gas and oil, is somewhere on the order of magnitude of at least 3%. I've seen some estimates as high as 5%. And that's largely going to come in the form, of higher input prices. Europe's about a quarter of global GDP, so if that's taking a 5% hit, that's pretty meaningful. And then finally, and I'd say this is the most important one, is the lack of certainty on the trajectory of short-term interest rates in the United States. This is a long chart of core inflation in the States versus short-term interest rates. We could get this chart going back as far as 1960, and you can see more often than not, short-term interest rates are above inflation. And that sort of makes some intuitive sense, right? If central banks are looking to cool inflation, pardon me, they want short-term rates to be higher than inflation. And right now we're far below inflation, even with the Fed hike last week. And so one of the things that's really troubling the market right now, and I'd say the main thing, is this fear that short-term interest rates are going to have to settle in at a level far above inflation expectations for a period of time. So the inflation data comes out this week. The CPI data is coming out on Monday, and the producer price index data is coming out on Thursday. They are expected to cool off a bit, but they're still going to be running high, 6-7%, something that order of magnitude. And even if inflation a year from now sort of settles in at 3%, the acute fear in the market is that short-term rates are going to have to go to 4%. The other sort of nuance here is that, of course, there's congressional elections coming up in the States in November. And I think this administration has clearly signaled, unlike the Trump administration, and even unlike the Obama administration, that they're not overly concerned with the stock market levels. They will, the US voters on the coasts that have taken a hit on their stock market portfolios, that were going to vote Democrat are still going to vote Democrat, but swing voters in places like Pennsylvania, Florida, Ohio, they will they are absolutely feeling the impact of inflation. And so the Democrats are much more concerned about trying to get inflation under control and retaining as many of those voters as they can, more so than sort of propping up the S&P 500 and having that wealth effect maximized in society. The other thing to sort of note with short-term rates, and why this is so important for the trajectory and the level of the equity market, is it will transmit first into the credit market, into the equity market, which is kind of what those bottom right comments are about. With Fed funds at 75 basis points, that's not going to put a lot of pressure on credit spreads. As we start to get higher, 250, 300 beeps, God forbid, 400 beeps, that's absolutely going to put pressure on what's called investment grade spread. So that would be the interest rate differential between, say, Verizon bonds and US government bonds at the same level. And it's going to put even more stress on high yield debt spreads. And as those spreads widen, it absolutely puts downwards pressure on the price earnings ratio that the S&P 500 and stocks generally are going to trade at. So this is, I think, the key anxiety in the market, is the lack of visibility of how high short-term rates have to go. If the inflation data does start to cool and the market starts to think that maybe short-term rates are only going to go to, say, 2.5 or 3%, I think that could absolutely help sort of form a bit of a bottom in the stock market. But if the inflation data stays high, that fear of significantly higher, call it 4% plus short-term rates, is absolutely going to be there in the market. The inflation data comes out the second week of the month, so usually 10th, 12th, something like that of the month. And we have 2 more Fed meetings this summer. There's one around the 3rd week of June, and then the final Fed meeting before they break for the summer is in and around July 25th. And if the inflation data does cool a bit, we're going to get 250 basis point hikes, I think, regardless. That's reasonably well understood. But if inflation data does cool a bit, and then maybe the Fed commentary and the Fed press releases and the press conferences start to get a bit more dovish, that could put in a bit of a bottom on the market. But the reverse risk holds true as well. If the inflation data comes in worse than expected, we could absolutely see this weakness we've seen year to date continue through to the summer months. Global GDP expectations are slowing. The chart on the left is the IMF forecast, and the 2022 and 2023 numbers have come down a bit. A big number to watch is that 4% level on the left. 4% is a bit of an over-under on global growth. Generally, above 4% is an environment where you're going to see probably persistent upwards pressure on commodity prices. You're probably going to see a bit of downwards pressure on the US dollar or upwards pressure on non-US dollar currencies. And it's just an environment where growth is healthy. You'll see an upward sweeping yield curve, but the reverse holds true as well. And then OECD leading indicators have been rolling over after having peaked sort of roughly this time last year. I'm sure we'll get questions as to whether or not a recession is imminent. And it's, for what it's worth, the house view is we don't see a recession coming. But irrespective of that, it absolutely looks as though growth is going to cool over the next couple of years here. This is another way to look at it, which is US GDP estimates. The purple line on the top there is the 2022 estimate, and we can see how it's down by about 90 basis points just over the past 6 or 7 months. The 2023 estimate was already a very, very modest, like 2.5% to begin with, and is back down, is getting closer and closer to 2%. And that's sort of in contrast to these robust inflation numbers. So this is, this in a nutshell is why the market's spooked, because growth is decelerating. but inflation is not yet rolling over, which is a bad combination for risk assets generally. Now, on more positive news, we're essentially done what I'd call earnings season in the United States, where companies have reported their quarter ends for March 31st, and it's come through okay. We'll come to the US numbers in a bit, but overall, global earnings estimates have held up reasonably well in recent weeks. And basically what's been going on is, even though margin expectations are down, revenue growth expectations are reasonably robust, because for the time being, companies have been able to put through price increases. So revenues are up, margins are down, but operating profits are largely unchanged from where they were at the start of the year. We sort of, I talked about one set of conditions that can help put in the market bottom, which is cooling inflation data. The other thing that can help put in a market bottom is if these numbers can stay reasonably resilient over the course of the summer. So the summer earnings season will be done by roughly August 1st. So if we come through that period, and these squiggly lines still look roughly unchanged, the blue and the purple ones there on the top, that's absolutely something that can help put in a bottom in stocks. And then the reverse holds true as well. If these start to roll over, that could potentially be a further source of near-term weakness. So yeah, just a bit of a recap on earnings just in the States. A bit of a busy chart on the left. But you can see, so forward earnings estimates, this is as of, I think I did this on Friday, $234. So the multiples come right out of the S&P 500, right? We're at probably about 18 times forward now. And that's off about $1.50 in the last week. It had been as high as 235, so it's off just a smidge. And then the table on the right is just kind of how we've gotten there. Reasonably good earnings breadth. 7 of 11 sectors posted earnings growth. Most of the damage, discretionary, that minus 41, a lot of that was Amazon. The financials, I wouldn't read too much into that, because financials, banks took big provisions for expected losses in 2020. Then in 2021, they kind of goosed their earnings, if I could use that term, by releasing those provisions. And so I wouldn't read too much into the negative financials. The negative communications there, a lot of that is Facebook and Google. So not bad overall. But margins are coming down. 2021 was a record margins in the S&P 500 on an operating margin basis, and they are coming down, the margin expectations, which is consistent with the high input costs you're seeing. Okay, so market opportunities. There's a couple of big ones. Arthur, our chief investment officer, and myself did a call this past autumn where we talked about 3 or 4 secular long-term growth opportunities we saw. And so I'll just reiterate those verbally. Higher for longer information technology spending, both by large businesses, small businesses, and even individuals. That's one for sure. The green energy transition and the massive quantum of capital expenditures that are going to surround that. There's absolutely going to be some winners and losers there, but that's another area of opportunity. A third one is spending on healthcare, both by government systems as well as private healthcare systems, as well as private individuals. That was already picking up and was already strong even before the pandemic, and the pandemic's just accelerated that. And so those are 3 sort of key long-term secular trends where we focus on and keep our eyes open to. But over the more immediate term, tactically, there's a few things. One is valuation for non-US stocks, even before this year, was reasonably undemanding. US equities have been trouncing non-US equities since the global financial crisis. After the US, the second best performing markets in US dollar terms are Japan and Canada. And then European equities and emerging markets trail by a long, long way. And the valuations, both on an absolute and relative basis for non-US stocks, weren't demanding before this year. and now at sort of 13 and a half times forward earnings are reasonably undemanding. US stocks are still a bit pricey. I've got another chart to kind of speak to that, but they're certainly off of their peaks. So the valuation backdrop is not bad. We're not yet, I'd say, where stocks are table poundingly dirt cheap. I'm happy to share that level maybe during Q&A, speculate what that might be. But one of the things you need the US stocks to keep coming down a bit before the valuation backdrop really becomes quite I don't want to use the term no-brainer, but it starts to the skew of medium-term outcomes starts to get super attractive. Same thing from a sector standpoint. So this is a chart. These bars here, aquamarine bars, represent the 10-year average price earnings for the various sectors of the stock market. So consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, communications, real estate, and utilities. And you can see more and more of these are coming into range of what the long-term averages are. And even technology, if we were looking at this chart a year ago, the spread between technology and its long-term average was much higher. The best two performing sectors over the long term are technology and healthcare in that order. And they're the best. They have the best organic growth. They have high returns, return on assets, return on capital employed, return on equity, whatever return metric you want to look at, they're the best. Typically strong dividends, strong balance sheets, and good dividend growth. And those are the factors that are going to drive sustained outperformance. And those are sectors that are important to us and where we expect to have a lot of exposure to both of them. We've been underweight IT for quite some time because the valuations had been so extreme there, but we have a significant overweight in healthcare, and we have had for some time. But big picture, on a sector by sector basis, we're seeing more opportunities for a longer time horizon than we've seen in a long time. When we look at stocks individually, it's always with a 2 to 5 year time horizon. Okay, and then just another chart on tech valuations. This is price to sales, which is a good ratio to look at in this space. And you can see it's come down from the peak, but it's still pretty rich at 5.5 times price to forward sales. Where does it kind of need to get to? You know, I'd say anything under 5, 4.5, 5 is probably a bit more realistic. We've added small positions in a couple of tech names in the past 8 weeks or so. It's something we're actively looking at. I would absolutely expect us to add further to technology sometime during the course of calendar 2022. But I don't know if we're there yet. The technical action in tech continues to be awful, and our underweight there has served us well on a relative basis, but unfortunately, I think it still has room to go to the downside. Okay, the third opportunity has to do with the U.S. consumer. The U.S. is still the biggest economy in the world. It's about sort of 25 to 30% of global GDP, depending on how you want to measure it. The U.S. consumer is 70% of that, and one of the reasons why we aren't overly concerned about a recession is that the U.S. consumer is in fantastic health. The employment backdrop in the United States is fantastic. And even though US consumers are dealing with higher gas prices and higher rent prices, wage growth has been so strong there that even for the lowest end consumers, it's been able to offset those impacts. Consumer confidence is down a bit from recent peaks, in part largely due to inflation. But it's still high on a relative basis, you know, and you can see much higher than it was during the financial crisis there. And then debt payments. So even though mortgage rates are going up, they're still very manageable in a historic context. So the low end US consumer is in good shape. The middle class US consumer is in even better shape. And the high-end US consumer is in absolutely fantastic shape. And because of that, we still see economic resilience in the United States, which in turn puts in a basic level of economic resilience for the globe overall. A final thing I'd point to is sentiment. Sentiment, understandably, has swung so dramatically in the past year and a half, right? It seems like a lifetime ago that we were reading about day traders trading stocks like GameStop in the United States, from their parents' basement, either literally or proverbially, and everyone and their cousin was trading options. And the barber that cut your hair wanted to get into extensive debates as to whether or not you should buy Bitcoin ahead of Ethereum or Ethereum ahead of Bitcoin. And that environment has changed, which is good. You're always a bit concerned. I use my father-in-law, who unfortunately exhibits every cliche of what not to do as a retail investor, as a good barometer of stock market froth. And a year and a half ago, my father-in-law was chock full of stock tips and wanting to discuss all sorts of low profitability businesses that were exhibiting fantastic stock charts. And that's swung dramatically. So this is the American Association of Individual Investors. The red crosses or plus signs are current sentiment levels. So you can see we're not at trough levels of bullishness or max levels of bearishness, but we're certainly sort of trending in the right direction. And so, a capitulation in sentiment and a capitulation in confidence is something you do need for the weak markets to bottom out. And another way to look at this was my colleague Cam, who covers consumer stocks and real estate stocks, first posted this on his LinkedIn on over the weekend, and I got a kick out of it, so I thought I'd share it here. And it's just so this talking about when CNBC, the broadcast channel, runs a Markets in Turmoil special, and what the stock market returns are in the year after that. We used to have another variation of this chart where it was a line chart showing the bull market after the global financial crisis, and CNBC calling a top of that bull market cycle every time. And because they were calling the top of that market every 3 months, so we put little arrows in about them calling the top of the market. And so I thought this was sort of a reminder of how important sentiment is when it's aligned with things like valuation, in terms of putting in a bottom of the market. So you can see that the 1-year average return here after CNBC runs these specials is 40%. I don't know if we've got 40% upside over the next 12 months, but you are starting to see some of the psychological signs that the market's kind of trying to find a bit of a bottom here. Okay, moving on to the portfolio update. So just a recap, you may have recalled myself or Daniel or his colleagues mentioning that we try and add value across both dimensions. So both in terms of generating excess return, as well as taking out as much volatility as possible. I half joke that all our clients want the same thing. They want 10% a year in US dollar terms with the volatility and the liquidity of their checking account. And that's impossible to do, right? Stocks, with the exception of commodities, and I guess crypto, are the most volatile of all asset classes, but nonetheless, it's those twin objectives we try and manage towards. And one of the tools we use to do that is we try and take reasonably defensive sector positioning. So the purplish bars there are where we are versus the MSCI world. And we're not a particularly benchmark constrained manager. We have very high what's called active share, but we're also not benchmark illiterate, I'd say. So the things I just point out here, big overweights in healthcare, somewhat of an overweight in staples, and then a big relative overweight in utilities. And those defensive sectors, sorry, pardon me, usually sum to about 25% of the market overall. And we'll usually have an overweight in those three of at least 500 basis points. We've been underweight technology on a relative basis, but technology is even bigger than this because, pardon me, sorry. You can see here it's about 22% of benchmark. But remember, Google and Facebook are in communications these days. So like 5 of that 8% is Google and Facebook. And then Tesla and Amazon both find themselves in discretionary. And they're about, call it, sorry, 5 of that 12% in discretionary. So we're actually pretty significantly underweight tech if you were to include those firms as well. No exposure to materials right now, no exposure to real estate. We like to have exposure not just to those defensive sectors, but to the sectors where we can find stocks with really high returns on capital, really strong prospects for dividend growth as well. Geographically, the big change we've made since the start of the year is we've brought down our overweights in Europe and Asia. So we're still overweight Europe, pardon me, and we're still overweight Asia versus benchmark. But one of the, I think, unfortunate but practical byproducts of the war in the Ukraine is that the risk premia that you associate to European investments, including stocks, has to go higher. So we've cut back our exposures there. On a net name basis, they've gone down a little bit, but typically what we've done, because the companies are performing well and they're still good stocks, is we've just taken basis points out of those. So the allocation to North America has gone up a bit as well. And so, one of the issues in this mandate in terms of relative performance is the benchmark's not a particularly good one. And what I mean by that is not only does it have probably too much in technology, it also has too much in the States. When I started at Seidel in 2004, the United States and Canada were only about 54% of the MSCI world, about 50 or so in the States, 3 to 4% in Canada. And now that's up above 70%. And that's, and by contrast, the States is only about 25 to 30% of global GDP. So there's a big mismatch between market cap and global GDP in the MSCI world. And that's been exacerbated because US equities have outperformed non-US equities for so long, but that's not inevitable. Unfortunately, over the short to medium term, the most realistic way by which non-US equities outperform US equities is by lower geopolitical risk and higher growth expectations. And both of those things are difficult to see right now, at least over the short term. So we'll, when we pick the stocks, it's always from a bottom-up basis and a bottom-up framework, but we do sort of use these geographic buckets to ensure broad-based geographic diversification in the portfolio. As I mentioned, we've been trading a lot. Usually, there's 38 stocks in the global equity portfolio right now. Normally, the range is 30 to 36, so we're slightly above, pardon me, the expected range right now. Partly that's because we've seen some good opportunities open up. One of the things we've sought to do with the portfolio changes is to minimize exposure to names where we think they could have pressure putting through prices and poor pricing power. So, Panasonic, CRH, which is an Irish cement company, Heineken, and Mondelez, which is a food company, and then Cadbury chocolates. We suspect that they might have difficult pricing power. The names we've added on the left, Scout24 is a German real estate listings company, the market leader there. That's a space where we we're pretty bullish on. CSL makes and distributes plasma. That's an Australian stock. Again, healthcare is a space we like, and that stock's been weak for a couple of years just because plasma collections had really dipped down during the pandemic, but we think that's kind of bottomed out. PayPal and Mercado Libre are two high growth technology names that have been absolutely crushed in the past 6 to 9 months. They were massively overbid as shares in 2020 and 2021, but their prices have come down to the point where we think they actually look quite attractive on a 2 to 5 year basis. For the stocks to start working, we do need some confirmation that inflation's peaking, but we've just put in very small positions there, about 100 basis points in each name. Louis Vuitton, Moet Hennessy, so well-known luxury goods brand. They also own Tiffany Jewelers. They also have a watch business. They own Zenith and Tag Heuer watches as well. But they're going to have better pricing power than a lot of other consumer spaces will in this market. So conceptually, Louis Vuitton can be thought of as a replacement for Heineken and Mondelez. And then Lockheed Martin, large U.S. defense contractor. We'd owned defense stocks in the past. We used to have Raytheon, and then Raytheon merged with United Technologies, a civil aviation business, and we weren't overly keen on that deal. So we sold Raytheon, and we'd been thinking about getting back into defense for a while. And absolutely, the war in Ukraine accelerated that. So we've actually put in a reasonably large position of about 300 basis points in Lockheed Martin. We put that in, a couple of days after the war started, and we're off to a good start with that name. I'd expect us not to be this active on the remainder of the year. I mean, never say never, but we've turned over, in effect, about 20% of the portfolio. Normally, I expect. I think there will be a couple of more trades in the next couple of months. We have some things in our crosshairs, but hopefully we've settled down. From a portfolio manager's perspective, you're always trying to balance two things during these risk-off periods. You're trying to provide as much shelter during the storm as you can, but you still want to capitalize on opportunities to maximize the long-term capital appreciation portfolio of the portfolio. So, you're over the short term, those objectives can kind of very much be at odds with one another, right? But that's the those are the tricky waters you're trying to navigate, and we're reasonably pleased, with these things we've added in, and we're absolutely seeing opportunities both to reallocate basis points amongst the existing names, as well as to bring in a couple of new names into the portfolio that, again, we think will add to the long-term capital appreciation potential. So just a recap of our top 20 holdings here. The one thing I'd say, and I just reemphasize, is even if we're wrong and we do go into recession, all of these stocks will pay their dividends. Most of these stocks will increase their dividends. All of these stocks either have no net debt or have investment grade balance sheets, which means that if we are in for a period of prolonged economic weakness, they'll have the opportunity to either grow their businesses organically by having the cash flows and the balance sheet strength to invest back in their businesses, or to grow inorganically by picking off some of their weaker, harder hit rivals. So it is a strategy, as you may recall, that invests in both big and small companies, and invests around the world. But there is that quality characteristic. The style we have is sometimes called core quality. Core meaning it can be the basis of a global equity allocation, and then quality because in terms of things like return on equity, earnings variability or lack of earnings variability, and cash flow generation, we score very, very well. So, one of the points we make with clients during these risk-off periods, of which there haven't been too many in the last 15 or so years, right? After the global financial crisis, 2018 was really only the first year we've had in that period where we've had negative returns. And this year is shaping up absolutely like it'll be another year of negative returns. But it is a message we do want to hammer home, is that these businesses have staying power. The cash flows they generate, they might be down a bit if the economy really cools, but they're going to be resilient. The other point I'd make is we eat our own cooking, right? I've got half of my own investment portfolio in our global equity portfolio. The other half is in other Sidel portfolios, principally our Canadian equity portfolios. And it's the same thing with everyone that works with me on this mandate, Stephen, Phil, Cam. they're all heavily invested in the global equity portfolio. So we eat our own cooking. And I think that's important to reiterate, is our interests are very much aligned with those of our clients and investors. So just in conclusion, our crystal balls are no better than anyone else's. But if I had to guess what we're looking for over the short to medium term, is we can expect to see some weakness over the next couple of months continue, for that main reason that there is a very specific fear out there that short-term rates aren't going to stop at 2.5% or 3%, but that they're going to have to go higher, like 4% or something, for a period of time. And that's absolutely going to put pressure on the bond market, which in turn is going to put pressure on the stock market. The second point I wanted to mention doesn't actually pertain to the equity market, but it's just sort of a big picture thing, because you read in the financial press about bond yields going up, and this is sort of being described, as like an invasion by the Hun or apocalypse or something. It's not. It's entirely healthy. Investors and savers should be able to buy a risk-free asset and get some sort of rate of return that at least approximates inflation expectations. So the fact that we've seen the U.S. 5 and 10-year yield move above 3%, and correspondingly investment grade bonds of similar maturities go above 4%, it's painful for the valuation of bond portfolios over the short term, but big picture, it's unambiguously good news for investors and for the capital markets generally. We would be much more concerned if we were having this sort of inflation data, but bond prices were staying very, very low, because that would signal just abject confidence on the part of bond market participants. And then the final point I wanted to make is that a key reason why we focus on quality businesses as opposed to speculative stocks or trading momentum is precisely because of periods like this. Unfortunately, the price of shares of the businesses we invest in will go down in this kind of environment, and they should go down less than the market overall. But one of the benefits of quality in terms of cash flow generation, dividend growth, earnings resiliency, high returns on capital, is that these are businesses that will have the staying power to weather a storm. And so, as I mentioned, I'm an investor in the pool, and obviously I'm not delighted to see my own account go down in value, but I sleep easy at night, and we want our clients and investors to be able to sleep easy at night, knowing that this storm too shall pass. These companies aren't going anywhere. These businesses aren't going anywhere, and that they absolutely have the capital that'll bounce back and participate when conditions calm down and the next market cycle starts.
This podcast is not a recommendation, offer, or solicitation and cannot be relied upon as investment advice. Listeners should not use this podcast as a sole basis for any investment, financial planning, tax, or other decisions. The information presented today has been compiled from sources that are believed to be reliable. However, no representation is made as to its accuracy or completeness. All opinions expressed herein are based on information available at the time of publishing and are subject to change without notice.